Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Kalra of Target Investing and independent advisor Sharmila Joshi join me on the show. Thank you to both of my guests for joining me. Today on Hot Money, we'll discuss stocks like Dilip Bilkon, CG Power, Astral Poly, and we'll talk about the companies that have fallen significantly, REC and PFC. So let's get started with the first stock, and that is Dilip Bilkon. The counter has corrected significantly. Today it has managed to hold up a little bit, but there were a lot of concerns. First of all, there were a lot of rumors in terms of whether the auditor has resigned or no. That has been concerned. That has been addressed by the company. But now this brings a lot of questions to how the performance is, how the balance sheet is, and post the management clarification which they've given on several occasions. Is this something that you would trust, or are you convinced with the management version of the story? What's the way ahead for Dilip Bilkon? So Samir, I'll start with you. A lot has happened. The counter has corrected significantly, almost 20-30% post all the rumors that came out. There were some blogs that were written. What's your personal view on Dilip Bilkon, the financials and the company and such?
So even before this came up, we don't prefer Dilip Bilkon. I'll give you two very simple reasons. If you see receivables are very high, so any work you're doing, you're not getting payment in time. And there are certain delays coming up now if you see the quarterly results. Second, the debt is around 5,500 on consolidated for March 2018 and around a net worth of 2,300. So see, if you track L&T always says that the contracts which you have been awarded should be based on their net worth. And I think when the net worth is so small and your order book is so big, there is a very downside risk in your system. It can be, accounting issues. There can be a corporate governance. There can be delay in payments. Anything which hits it will be a significant downside. So I don't think so. This is a stock where I would like to be.
Okay. So it's a negative that's coming in on Dilip Bilkon. Do you like the stock, or do you share similar views on the company?
Well, I don't share similar views because I think that at the end of the day, even if you were to address this whole auditor issue, and even if it were true, I think that the point in favor of Dilip Bilkon is that their results are announced. Their results are out there. This is not something that has held up the results, which has been the case with the other two companies. So I think you have to take that into account as well, because that is definitely, I think even there was another company which there was some concern that auditor has resigned, but the numbers are out. So an auditor then resigning should not be immediately cause you to hit the panic button. And overall, I think that I'm positive on this road building space, because we are getting into election year. NHAI is likely to step up orders, and I think you will see this kind of a sort of a debt position and whatever, because I think L&T is in a separate bracket by itself, because they're doing other projects as well, they're doing larger projects as well. So I think where Dilip Bilkon is concerned and the kind of projects that they are handling, results were decent. NHAI orders likely to step up. So I'm not saying that go and buy immediately, but I think that the stock has now corrected fairly decently given this run of bad news.
Okay, so I think that's the view that we're getting in on Dilip Bilkon. We have one positive view and one negative view. We'll open it up for discussion. I'll start with you, Sharmila. The margins are way ahead. They are almost 18-19% to even some of the other companies which pretty much do high single digit or very low double digit margins. Do you find these margins credible? No doubt the management has said that they have their own equipment, they don't outsource work, but does that lead to almost a 8 to 10 percentage point increase? So are you convinced with the numbers that have been put out?
See, I think the problem with all these things is that yes, you can raise these kind of questions, and I think they are completely valid. But I think where this whole auditor issue also, I think the way it is playing out is that we don't actually know at the end of the day. Nobody is really telling us what the real reason is.
No, but the auditor hasn't resigned.
No. What I mean to say is that even in the companies where it has resigned, where you know outright that they have resigned, we don't know the real reason why they have resigned.
No, but
we don't have that on board. Nobody is answering those questions for us.
And Vakarangi. Yes. But the management has clarified, the auditors have said that there's nothing wrong.
No. So what I'm trying to say is that even when things are wrong, we don't know what was exactly wrong. So here, this is all speculation. So yes, I think these are valid questions. They should be raised.
I don't think anyone's questioning whether the auditor resigned or there was this thing. I'm just asking, are you now that all these things have happened, people have started questioning how come you are able
Yes,
to
so give them a
in
chance
such a competitive
to,
in such a competitive scenario.
Correct.
How are you able to do margins of 20%, which even an L&T doesn't do?
Correct. Absolutely.
So,
I take the point.
are you okay with the fact? Are you convinced that they are actually doing 18 to 20% margins?
No, maybe they're addressing their books in a way to make it look better. But I think that we have to, if the company is saying that this is the reason why they're doing it, we have to take it with a pinch of salt. You have to factor that into the valuation. Don't think that, oh, this is a very high margin business and that's why buy into it. I'm saying buy into it because the order outlook looks good going ahead for the entire space, not just Dilip Buildcon. So maybe I won't buy Dilip Buildcon in that space. I may buy a KNR. But what I'm trying to say is that this is a space that looks good to me.
Okay.
And I have to go with what is the information put out there. I have to believe in it. So if the company is saying something, the auditor is not contradicting them, then I have to go with that.
Okay, so that's the view. What about you? Are you convinced that such margins are possible in EPC? A couple of other companies do it, so I'm not saying that this it did, but given the size and how concerned are you of the debt issues of the company?
So I'm more concerned about the debt issues because in these companies, what happens when everyone expects the road expenditure to be going higher and higher year on year? That's not possible. What happens generally, your budget starts squeezing in as soon as you come closer to the election year. What happens over there, you're spending more on the public places rather than on the infrastructure side. It's a regular belief that the infrastructure spending goes up, but it generally comes down on the last year of the government formation, before the new government is formed. So secondly, what happens if you are creating that kind of a 18 to 19, 20% kind of a margin, you have to take care that how is it funded. Now, if you're creating even a 20% margin and you're giving that chunk of the margin back to the bank, it doesn't interest me. I rather have someone who's generating a 10% kind of a EBITDA margin, has very less bank debt, and giving back that more of the EBITDA margin to the shareholder. So I'm more interested in that. If they are able to sustain it, which I highly likely doubt, because what happens when you're creating more EBITDA margin through bonuses? So generally they try to complete before time and get bonus out of it. That bonus gives you that higher EBITDA.
But that is what the management also said.
Yeah.
So we had him on air, and the reasons he said was that they don't subcontract, they have bonuses that leads to top line growth, and they have their own equipment. So,
but that's what I'm saying. So even if you have your own equipment, there's a higher risk to that, right? So when the orders execution falls, you're taking a capex or a fixed cost of that also. Secondly, if you're doing on bonuses, you are not depending on the payments to come to complete the work. You're taking a loan from the bank to complete that work. So that is also a double risk. So while the system is growing and you're getting good execution, it's good enough. The day it starts faltering out, it'll be a very high risk for you.
Okay.
So I rather stay away from it because I don't think so these kind of companies actually perform very well.
You mean the entire road sector as
No,
such?
no, as in which try to force themselves on the higher margin through debts.
Okay. So that's the view that's coming in on Dilip Buildcon. Samir is rather negative on the counter. Sharmila is bullish on the entire road industry, not only Dilip Buildcon. But I think viewers should take their own choice. They heard both sides of of the argument of why one should buy it or why one should avoid it. But the next talk we want to talk about is the fact that we want to talk about Crompton Greaves. Now the counter did correct significantly. I think it suddenly cracked. I think a while ago it was up in trade. I think yesterday it cracked almost 20%, and if I see it right, it's down another 11%. So something seems to have gone wrong. The numbers were extremely weak. Is this a good time to buy? That's the question that we're asking. Samir, what did you make of the numbers and the fall that's coming?
So if you see the numbers, there were two parts to it. One was without the exceptional items. So they have lent to a lot of their subsidiaries in past. Now they are writing it off. So they wrote off around 400 crores kind of a loan which was given to a subsidiary as a bad debt. That affected the net profit. If you see on the operational side, the power business margins are stable YOY. The revenue has slightly grown, but if you see the industrial systems, the margins are growing drastically. So, but I still should keep away from it, because the only point is these kind of changes really don't are not short-lived. These are more like gradually, and it's happening since 3-4 quarters in past. So I think once it's done, then you have a edge over it. But I rather wait for it.
Okay, what about you, Sharmila? Your view on Crompton Greaves Industrial?
Yeah, I would also rather wait, because I think that, this 10% kind of fall is another, is sort of bringing it even lower. But I think that what we are also seeing in this market is that stocks where results are not in line with what you were expecting are getting punished. And, because, there is a general sell-off in mid-caps. And you're seeing a bigger sell-off on such stocks. Plus, results, as you're saying, if you remove the exceptional item, they were okay. But I'm not really liking the fact that you did such a big write-off either. So I would wait for a little while, maybe another quarter, and then really look at this company.
Okay, so I think it's a double negative view that's coming in on CG Power. Let's open it up for discussion. Sharmila, what's gone wrong for this company? I think not only few quarters, I think last 3 or 4 years they haven't been able to get anything right. The only thing that they did was, hive off the consumer business, which they sold out, and that company seems to be doing well.
Yes.
The other, they have not been able to sell their international assets. The domestic business isn't doing well. So what's plaguing this company? Because it's pretty much...
You've said it all.
Yeah, but how come they are not able to do it, while others are?
Yes, so that's exactly what plagues the market, because as such, the business that they've been left with, electrical equipment or, that business per se is not a bad business to be in. Of course, the consumer side of the CG, Crompton Greaves consumer was the better business. And you are, as you're saying, see it perform better there because you also have other stakeholders who have entered the picture there. So I think there is a bit of a concern with, what we were talking of, this exceptional item, the lending they've done to subsidiaries, and you just can't put your finger on it at what is it that is preventing them from getting it right. So which is also why you're a little cautious on this stock. So, if you have to ask about, Crompton Greaves, one would always go with the consumer name rather than the power. Okay. So, I still stand by that, if you had to choose between the two, I would go with the consumer business.
Okay, Samir, what's plaguing them, according to you? And will things get even worse for them now?
See, the only point is when you hive off the business, right? You need to have an equal focus on the business, and equal money should be available for that kind of a growth to kick in. So if you see the numbers are getting staggered on the revenue terms. When they get staggered, the whole point is the margins are not in your control because your fixed costs are going up day by day. So in that power business, that kind of a hit they are taking. That's why the margins are very stable. In the industrial, what is happening now, they are seeing a lot of orders kicking. So that kind of a margin upbeat is there, and there's a certain pricing change which is happening. But what has happened because of the loans which you have given, because of this, because they were huge in number. So that writing off is not finishing out. Okay. So that kind of trust goes out of the system, and then the valuations will not be given by the investor, even if it finishes off. Okay. So I think, and that's why the consumer business is much more better for them, because it's easier to be pushed, easier for the margins to be controlled, and less likely to be on a debt burden. Okay. So that's where the valuation goes higher on the consumer and reduces on the industrial.
Yes, so one more query, one more question that people raised was, and which they said was that, again, they've not been able to sell the Hungarian business, which is being a big drag. If that gets sold, is that a re-rating factor that you would look at?
See, the only point is if it's still not being sold, then at what valuation will you sell it off? Because the only point is, even if you sell it off, that kind of a upside for a short term might come, but your remaining business has to show the growth prospects and the whole changes in quarter to quarter performances to get that kind of a deserving valuations for a longer term. Yeah. So there can be a short term upside on the sale of the business, but I don't see it as a very major positive into the system. Okay, so that's the view that's coming in on Crompton Greaves. Actually, we had one query that came in on live right now on Dilip Bilkon. If someone can address it. Sunil Chahalis is saying, is Dilip Bilkon politically benefiting because of the current regime? Would anyone want to comment? I would like to stay away from it.
I think people would not want to comment it, but I think that it was a query, so we decided to take it. We'll leave it at that. But the next talk we want to take is a counter that's doing extremely well. Astral Poly came out with strong set of numbers. Astral Pipes is doing very well. It's up 1.5% above the 1,000 rupee level. What's the view ahead? What did you make of the numbers, Samir?
So numbers were good, but the valuations are too high. So, and see what happens for all the pipe companies. March quarter is one of the best quarters because of its pre-monsoon kind of a buying which takes place. And June is the lowest. So I would like to see the June performance and then take a look on whether I even want to enter at these kind of valuations or not. I prefer a Apollo pipe today over this Astral pipes because there's no, the capacity is still at 60-70% kind of a utilization and they're still adding capacity, which I don't find a regular reason to why to add when your capacity is already 30-25% empty. So I think I would rather stay away from it.
Okay, what about you, Sharmila? Any view on Apollo pipes?
So I think
Apollo Astral Poly, sorry.
Astral Poly. So I think that the pipe business is something that I like, and the results were good. And I also think that, just as we were talking in the case of Dilip Buildcon, I think, there will be some obvious sectors which are selected which will give the government visibility going ahead. And you could see more orders coming there. So I think anything that is sort of related with, the pipes, the irrigation space, that also is likely to construction, that is likely to see a boost in this coming year. So I don't like the valuation the stock is at, but otherwise I think this is a decent enough stock.
Okay, so I think again we're getting views in terms of the pipe space. We'll open it up for discussion. You said you like the pipe space, so which are the stocks that you like? If someone wants to take exposure, which one is the one? One
is Apollo Pipes, Phenolics. And then I think even in the oil and gas space, now that you're seeing this kind of a search for crude, you will see a lot of those type of companies also getting orders. So those pipe stocks could also be something to look at, like a Maharashtra Seamless or Jindal Saw or whatever. So I think it's an interesting space to look at.
Okay, so pipes is an interesting space, but I think valuation concerns on Astral Poly. Why are you bullish on Apollo Pipes? And compared to Astral Poly, what are they doing better if the scenario analysis?
So see, if you see Apollo Pipes, they were concentrated on the west and the south. So now they are expanding to national regions. Okay, so they are adding capacity. They always had a capacity issue. So now they are adding capacity at a very rapid speed. They have gone around a 35% kind of a capacity addition, which has got utilized in this quarter itself. They're going around 150% kind of a capacity increase versus compared to FY17 to FY20. So that's a big jump. And they're doing it with mainly on internal accruals. So they're not taking debt to fund the whole system. They are only taking 20% of debt for that capex to be funded.
Okay.
So I think over there they're leveraging the Apollo tubes distribution.
Yes.
So it's easier for them to push the brand, and they already have a branding systems. So, and for them it's easier to distribute that sales into the wholesale market.
Okay.
So I think that will benefit them.
And valuation wise, how does it compare to Astral Poly?
So Apollo Pipes, if I take a valuation right now, it's around 35 to 40 times forward PE. And I see that reduction in debt is taking a benefit out of that premium valuation they're driving and the volume growth they are showing. But still, it's a June quarter which goes lean for the whole industry. And that's where the valuation certain times comes off.
Okay.
So I would rather wait for the June quarter and then add to it or start buying it.
Okay, so that's the view that's coming in on Astral Poly. And the last sector that we were talking about is the lending space, and there are pretty much two players, the PFC and REC. Both of them government owned, and they've been beaten black and blue. Numbers came out extremely disappointing, very high provisions because of the RBI circular that came out. But somehow the management is remaining very optimistic. They've given an optimistic scenario. But the big question we're asking is the bottom made for REC and PFC? That's what we'll ask our guest. Samir, is the bottom made or is there more pain?
So I think there is more pain.
Okay.
Because the RBI circular says whatever is there in the real time has to be recognized now onwards.
Okay.
Earlier it was like if PFC recognizes, it's not generally compulsory for REC to recognize. Now if REC recognizes, PFC has to recognize the same as a NPA at that time. So, and it happens in real time. Real time means that once 180 days kind of a system goes out, you have to start doing it. and that will affect their numbers very drastically, because if you see the thermal capacity is around, PLFs are around 55 to 60 for past 2 years. So if the capacity is, utilization is down, you're not able to even meet the fixed costs. That affects your whole margin, and that affects the payments of the debt. And I think Ministry of Power and Ministry of Finance are still talking of what to do about that 45,000 kind of outstanding, which has to be recognized in that system.
Okay,
so
we'll come back to this. Your time is up. And what is the bottom made for REC and PFC?
Well, I think, on the front, I think a lot of these problems were already recognized in this, when you looked at these stocks. So I think the stock price sort of adjusted for that. So I think in the sense of the stock price, I think the bottom has been made. My concern is really to do with business growth, what Samir was alluding to. So I think my concern stays there. So I think that maybe in terms of stock price, they may have taken a lot of these issues into, whether it is the provision write-off or whatever. I think, it was very apparent that the reason why this whole space is seeing this stress is because people recognize that that is going to show on their books. So I think that stock price bottom was made, and I think even in PSC numbers, you could see that there was an improvement, but not to the extent market expected. So you saw the stock rally a little bit, and now it's hanging around there. But going forward, I think my concern is on business growth, because that, as what you all were talking of earlier, you don't really see any solution to the problem that the sector finds itself in. And unless you do that, then till then I will not be positive on these stocks.
Okay, so that's the view that's coming in on PFC and RSC. They believe that there could be more potential downside. Samir, what could be the re-rating trigger for these counters? Valuation wise, I think they have come to rock bottom, but is potential of, you believe that there will be more issues, but growth wise, do you see any kind of green shoots coming in anywhere?
See, I don't see it, because what happens, they generally lend to the thermal system, and thermal additions in past 2 years have been very low. The solar addition is being funded through PE investments. So the lending part can be only done once the whole NPA system is recognized, the whole system is out, and they start refinancing it at a higher cost. So that's where I see a different, so where your NPA growth is lesser than your book growth, and that the new book is at a higher cost. So I think it will take at least 6 to 9 months for that system to kick in.
Okay, what about you? Do you see any kind of green shoots that are coming in? Valuation wise, you're fine, but growth is a concern. But any kind of green shoots that you're seeing on
honestly, no. Because I think that this has been recognized as a sector which has been under, which has had its issues for, I think, more than 7 years at least. And I don't know. I mean, the problems are at many levels. It's not. This is not the only level that the problems are at. So at one time you thought that they were making an headway and you were sort of getting to the bottom of all this. But now again, after, whatever, 4 years of this government, I don't really see the situation having substantially improved. So very honestly, I mean, Samir was talking of 9 months, but I would probably give it at least another year before you see any significant change in this situation.
Okay, but if someone wants to invest for the long term, then also you would not...
As in, they can start putting a smaller amount of investment, as in have a 1% or 2% kind of a portfolio put in over there. And then you need to have a conviction that even if it goes 20% down from here, I'll add. If you're one of those investors that it goes down, because there is a downside over there. So if it goes down and you start selling, it'll take a while to come up. But there is a certain downside, and you can start buying in smaller chunks and tranches.
Okay, with that we'll wrap Hot Money, but we have one interesting link that's there. But Sharmila and Samir, thank you so much for joining me. May has been a tough month for fuel retailers. While initially they couldn't hike prices in the lead up to Karnataka Assembly election, the subsequent rise has invited some criticism from different quarters. Add to the sharp rise in crude prices, not that most of them could find any solace in the fourth quarter numbers, when they were allowed to pass the higher crude prices to the consumer. So what hurt the OMCs the most in the fourth quarter? Somit tells us. Somit, what exactly were the reasons?
So if you see in the fourth quarter, it was the lower inventory gains, because of which the EBIT of two oil marketing companies came down. But BPCL was a standout performer in the fourth quarter, because it was the only oil marketing company to see an uptick in its EBITDA, that is earnings before interest, tax, depreciation and amortization. Now BPCL's EBITDA increased by around 17%, by that of IOCL and HPCL declined. IOCL's EBITDA came down by 17% and HPCL's EBITDA came down by 8%. Now, this was mainly because of lower inventory gains in the fourth quarter of financial year 2018. So, if you see the inventory gains, now Indian Oil Corporation's inventory gain came down by around 45%, while that of HPCL declined by 89%. Now, BPCL's inventory gain also declined by around 72% to close to 449 crore rupees, but it was the strong operational performance both in the refining and the marketing segment of BPCL that led to an outperformance in the fourth quarter of financial year 2018. Now, one key thing that worked for all the three oil marketing companies, it was their outperformance in the marketing segment. Now, if you see the core marketing EBITDA for all the three oil marketing companies, it has increased compared to the last quarter. Indian Oil Corporation's marketing EBITDA increased by 22%, while that of HPCL jumped 2.7 times to 2,515 crore rupees in the fourth quarter of financial year 2018. BPCL saw a positive core marketing EBITDA of close to 1900 crore rupees as against a negative marketing EBITDA of 11 crore rupees in the last quarter. Now, this is despite no major change in the sales volume. Now, if you see the petroleum products sales volume, it has declined for Indian Oil Corporation by 1.1%, and that of BPCL and HPCL increased by only 0.8% and 0.1%. So, despite any major change in the petroleum sales volume, we had seen an uptick in the marketing EBITDA, and that was because of the increase in the gross marketing margin. Now, if you see the gross marketing margin earned on sale of every liter of petrol and diesel, that increased to 2.9 rupees per liter in the fourth quarter as against close to 2 rupees per liter in the third quarter. Now, because of this change, we saw an uptick in the core marketing EBITDA in the fourth quarter. However, going forward, that is in the first quarter of financial year 2019, if you see it is again on a downtrend, and the first quarter so far it has averaged around 2 rupees per liter for the three oil marketing companies. And along with this, if you see on the refining side, the Singapore gross refining margin, that is the Asian benchmark, now that has also declined to $6.5 per barrel so far in the first quarter of financial year 2019 from $7 per barrel in the last quarter. So these two indications of declining gross refining margins and the decline in the gross marketing margin are showing that the first quarter of financial year 2019 could be a bit weak for all the three oil marketing companies.
And Somit, how do the valuations appear for these companies?
Valuations, that is EV to EBITDA for all the three oil marketing companies, all the FY19 EV to EBITDA is trading at a discount to 5-year average EV to EBITDA. For HPCL, it is trading at a discount of 23%, while for IOCL and BPCL, the FY19 EV to EBITDA is at a discount of around 12% and 6%. And if you see the 12-month return potential that we get from the Bloomberg terminal, that is showing that HPCL is expected to give the highest return over the next 12 months. The return potential is close to 31% for HPCL, while that of Indian Oil Corporation and BPCL is 28% and 20% over the next 12 months.
Okay, many thanks for that, Somit. But with that, it's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg.